Hello and welcome to today's video. The stock market is a dangerous place. Fortunes are made and spoiled in a blink of an eye. While many investors are bullish overall in the market, but many seasoned investors, they are still nervous on certain political and economic environments. In this video, we'll discuss 4 important steps that any investor can take when the market goes down and what you can do to save your portfolio from the downfall. So like and subscribe this channel right away so this video can reach a lot of people. Number 1, liquidate risky positions. See, what happens is when you sense danger in the market, when some investors, they sense danger in the market, they sell off everything. They follow the market, they follow the herd, they follow the noise that is in the market. People are running wild. They are selling off everything. They do the same. They sell irrespective of anything and everything they hold. They don't look at those companies. They don't look at the company valuations. They don't look at the business future of the business. They just go on a selling spree. They sell on the risky positions, stocks with high beta or high volatility history, and those with new business models. And even they sell stocks that are large caps. They sell their positions on the more stable companies just to avoid the losses. But what you should be doing actually is, instead of selling off everything, you should concentrate on selling off the risky positions. Just like I mentioned, you might sell off a company which does not have a long business history, which does not have a stable market condition, which does not have a sound business proposal. You had it because there was a news of it going up, and you took it just to capitalize on the advantage. So sell off those risky positions, but hold on to the positions on which you have companies that are more stable, companies that can give you good returns, stable, sound returns, companies that have good, sound fundamentals. Do not sell those off, because these are the companies that will give you a stability in your portfolio. The seasoned investors don't do that. They do not follow the herd. They simply do not follow the herd. So sell off the risky investments and hold on to more stable companies that are blue chip companies in short. Companies that have a stable business background. Number 2, have cash at hand or hold cash. See, some investors, they do not keep buying in this market. When the market is falling, they simply do not invest anymore. They stop investing and they keep piling up the money. The money that they have, it gets accumulated in their account and it does not go into the market at all. They do so to hedge against the portfolio losses. See, this technique of holding cash when the market is going down actually allows you to hedge against the falling market when the market is going down. See, holding cash relatively allows you to weather the storm when the market turns south. You might see your portfolio has come down substantially. You might see you have lost 20, 30, 40% of your portfolio, probably. But with cash at hand, you are actually waiting for the right moment to enter the market once again. And that entry, when the market turns the other way around, will give you a massive, massive boost in your portfolio. And this massive gain that you get when the market turns the other way around would actually nullify the effect of the losses that you incurred in your portfolio earlier on. So hold on to good stocks. Yeah, definitely sell off the risky positions. Hold on to good stocks and hold on to the cash, to the extra cash that you have been investing in the market. Do not invest. Hold on to it for a while if the market is falling badly. Just hold on for the right moment, and when the market is down at the very bottom probably, then start pushing in the money and start investing. The amount of losses that you have in your portfolio, it'll nullify out when the market turns upside down. See, now the disclaimer, this technique of holding cash is not for a long term. It's not a long-term strategy. It's only when the market is falling badly. People do it quite often, like, a simple dip in the market, like maybe 1 or 2%, 5% dip in the market, and people start holding on to cash. No, that's not the one. When there is a major crash coming in, probably it'll take some time for you to understand that it's a major crash or not. But maybe just think of 2008, think of 2020, Corona. Moments like these in 2008, 2020, the market went down substantially. Now that's when you should be holding cash, not in other times when, in the 2013, 2015 market downturn. Those were short-term market downturn. You wouldn't have predicted that. Even if you had, it wouldn't make sense to hold on to cash for some time. When there is a major downturn, that's when you should be holding on to your cash. Number 3, shop for fixed income instruments. What many investors do is they move their investments into fixed income instruments during this falling market. So probably when you're selling off your unstable positions, risky investments, use that money to buy in some fixed income instruments. Why? Because bond prices, it's generally seen that the bond prices, they rise in falling markets. Well, not always, but in long market downturn, it is seen that the bond prices also falls along with the stock market prices, but eventually the yield that you get from that bond would increase. But again, there is a word of caution. If you bet big in the fixed income instruments in the bond market, there is a danger it might lose value when the interest rates rise. Number 4, buy. Buy when the market's down. See, we know the gem of wisdom Mr. Warren Buffett shared. He says, be greedy when others are fearful, and be fearful when others are greedy. Which means, in other words, when the market is going high, it's flying high, there is a high chance that the market is going to turn around and show a dip. So be very, very fearful in moments like this. In moments like these, be very, very fearful, because a fall in the market price is likely to happen very soon. And on the other hand, when the stock market performance is not good, the investors are fearful, it's very likely that an upward swing is on the horizon. See, this is called the dollar cost averaging. Now, we discussed in point number 1 that we should liquidate our risky positions. Once we do that, we have the money and we start piling up or holding cash in falling markets. And when the market sentiment tells us that it's really fearful, people are really, really afraid to enter the market, it's probably time that the market has bottomed up. That's when you should start investing again in small chunks. Putting in money in small chunks at the very bottom probably would average out. We commonly call it as the dollar cost averaging. Well, dollar cost averaging tells to invest in any market condition, be it falling, be it an upward market condition or whatever it is. But here, if we start putting in the money at the very bottom, if we stop investing for a while and let the market fall down, let the crash take the major market chunk away, and then when the market sentiments are really fearful, that's when we should start investing our money back once again. Invest the money that we have sold off, that we got by selling off the risky investments, that we have when we did not invest and we started piling up our money. So use that money to invest in the market at the very, very bottom. You might experience a further downfall for some time, and then the market will rebound back. So nevertheless, you would still get to average out the bottom performing market. And from the very bottom, when you invest your hoarded cash and the investments that you have sold off, And when the market turns upside down from there, a big push would experience a big leap in your portfolio. So the bottom line is, no matter what strategy you choose, the goal is to avoid the knee-jerk reaction from the market. We always suggest to follow a slow and steady strategy to investing in the market because it gives you the best possible results. That's all for today. See you again in the next video. Till then, SC signing off. Goodbye.